How is everybody doing? Welcome back to another episode of the Banker Next Door. I'm your host, Dr. Joe Berquist. Today, I wanted to bring everybody an update on what was going on with the Synapse situation. If everyone recalls, a few weeks ago, I did an episode, if you go back to episode 157, which I called, Is Synapse Bankruptcy Going to Destroy the Banking as a Service Model, or otherwise known as BaaS? So I wanted to provide an update on this because one of the banks that was mainly involved in this was basically Evolve Bank and Trust. And what is happening now? Like regulators are starting to weigh in on this topic a little bit. So we're getting a little bit more feedback from regulators. And then what is ultimately, do we have any more information yet on what this means for banking as a service? What does this mean for fintechs that want to work with the banking industry? So let's go in and let's take a look at an article here. So this is from S&P Capital Intelligence, and this says regulators incorporate fintech partnership risk into bank capital plans. So, and this is from July 2nd, so this is from a few weeks back, but the recent cease and desist order against embattled Evolve Bank and Trust illustrates how regulators are increasing the scrutiny of banks' partnerships with financial technology companies and their potential impact on capital. The Federal Reserve Board issued the order on June 14th and identified deficiencies with risk management, compliance, and consumer protection and anti-money laundering rules in Evolve's banking as a service practices. Evolve, which is also dealing with the fallout from a cybersecurity attack and the bankruptcy of BaaS middleware vendor Synapse Financial Technologies, Inc., is now on deadline to submit at least 16 written plans over the next 2 to 3 months to improve its strategic planning in capital, liquidity, credit, and interest rate risks. It's so widespread, it's almost creating the bank in its entirety. It's almost recreating the bank in its entirety. Sam Haskell, managing member of Colarian Partners, said in an interview, Colarian Partners is an investment firm focused on bank equities, but is not an investor in Evolve. In particular, Evolve is asked to elaborate on capital risk management associated with BaaS activities. It reflected that regulatory reviews are becoming more granular as to how operational risk in fintech partnership weighs on an institution's capital, according to John Pompeo, partner at advisory firm the Gallatin Group. Basically, the Fed is saying that they have to manage their capital with respect to the technology risk. The emphasis on operational risk capital is a relatively new area of focus in recent years, says Jason Cave, senior consultant at Potomac Global Partners and a former official at the Federal Deposit Insurance Corporation. Regulators have started to expect BaaS banks to set aside additional capital to prepare for future disruptions, such as a breakup with a fintech partner. A lot of these exposures are more like contingent liabilities. If you only hold capital for your risks today, you will likely be short of capital for some of these things. So I think there is a greater emphasis from the bank regulators to say, we want you to hold additional capital for some of these events. One challenge is how to decipher the risks into a number, Cave noted. Unlike holding capital for credit risks, there is no historical data such as default rates for banks or their regulators to come up with a specific amount of capital to put aside. It is very difficult to come up with an amount or a range to say, here's what it costs to break up your relationship and all these things. Cave said it's a bit more of an art. So there's a lot to unpack with that. So first of all, let's take Evolve Bank and Trust. So unfortunately, these poor guys, they got hit with two things almost simultaneously. They got hit with the failure of Synapse, which kind of set a bunch of their customers into disarray as their accounts got locked out. Then shortly after that, they got hit with a cyber attack, and now I think what may or may not has it be known yet is basically, are these two things related? Like, did this cyber attack come from people that were upset because of what happened with Synapse and their accounts getting messed up, whatever? We don't know that. We don't know that, but I think it's just a question of, it'll be interesting to see what information we get on these things as time goes by, and get, kind of a little bit more information on this in the months coming up. So now this is basically prompted bank regulators to respond with in a certain way, kind of like a knee-jerk reaction, basically saying, well, hey, banks you're going to have to hold more capital aside for this. But as a couple of the individuals that were asked about this basically correctly pointed out is that, how do you put a number on this? Like, we don't have any historic data. Like, there's nothing out there that basically says, okay, here's a number you could put on that. Now, you, with your core, with bank, all banks have core system providers, right? With your core system provider, you have contracts, and usually those contracts could go 3 years, 5 years, 7 years. There are breakup fees in those contracts. So say you signed a 5-year deal, and after 2 or 3 years you wanted to get out of that deal, well, you'd have to have paid this breakup fee. So in that sense, you could put a number on, okay, here's what it would cost. But there are so many other dimensions to this. Obviously, if you break up with your core system provider, that's going to cause a major disruption to your bank. That's why it very rarely happens. Banks absolutely depend on that core system provider to run their bank day in and day out. So, but again, just to use that as an example, though, if you were going to do that, there is a detailed breakup fee, so you could potentially try to figure out, like, okay, well, what would that cost? But I think the same could be said for other fintech providers. But there's also so much more to this. There's disruption. There's time for what happens in the interim of you get rid of this service and you bring in another service, and how long does it take to get that service up and running, and what's the cost of that, and what does it cost you to have your people running around doing all this? So there's a lot of variables there that are very difficult, or could be very difficult to kind of figure out. Here's the other thing: when banks hold capital, that's less money that they get to deploy to put that money. In other words, think about it like this: you've got money in hand, right? And you want to put that money to work. You want that money you want to try to maximize the return that you can make on that money, and that's basically what's going on there. Banks are trying to maximize the return on the capital that they have, their return on assets, their return on equity. They're trying to constantly maximize this return. Well, but if you've got to continuously put a larger and larger chunk of capital on the side, that makes it harder for banks to maximize their return and make the most money that they can. And this is a kind of a never-ending struggle, between, again, banks would love to deploy all their money, keep a ridiculously low level of capital, and just get it all out there and try to make as much money as they can for it, which is great. I mean, that's kind of what happened before the financial crisis, before 07, 08, 09. Banks had a very low level of capital, and it was too low, and they were out there just, again, trying to maximize their profits, maximize their revenues, and so on and so forth. But then, it's kind of figured out that, like, hey, we got to hold more capital aside. So they've done that, and now banks have become well capitalized. There's a lot of money there. I think that has staved off a lot of potential problems that could be out there, because banks are more well capitalized today than they were 15, 16 years ago. But now it's like, well, okay, that's not good enough now. Now we need you to hold more and more capital. We need to hold, you got the Basel III endgame. You've got this. And it kind of leads to the question, like, well, where does this end, and how much capital is enough capital in reserves? And again, these are things that the industry is can continue to struggle with for years to come. This is not going to resolve itself in a day. So anyway, so keep it on here. So going from bad to worse. The ongoing incidents at Evolve illustrate the level of stress and disruptions in fintech partnerships that partnerships can cause for a bank. Industry experts cautioned that the largest risk lies in the unknown, because more issues could surface and put a dent in the balance sheet. The cease and desist order was issued at a time when the bank is flooded with complaints from customers of Evolve's fintech partners who could not access their deposits amid the bankruptcy of the BaaS middleware company Synapse. A preliminary investigation has shown a potential deposit shortfall of 65 to 96 million, as records of ledgering between Synapse and 4 bank partners, including Evolve, do not match. Separately, Evolve confirmed a ransomware attack on June 26th less than 2 weeks after the Fed identified deficiencies in the bank's information technology and security system. According to Evolve's disclosure, the data breach resulted from a ransomware attack by the Russian hacker group Lockbit, which gained access to its systems after an employee clicked on a malicious link. Regulators saw this coming with Evolve's recent cease and desist order, but could not act fast enough. Haskell wrote in a newsletter 5 points. The data breach, as well as other problems related to the Synapse case, could cause its fintech partnerships to be closed at worst and redirected to other bank partners at best, he wrote. Evolve plans to continue growing its BaaS business, which is the largest revenue stream, and a person familiar with the matter, but who declined to be named because they are not authorized to discuss the bank's communication with regulators. Some of its fintech partners include buy now, pay later lender Affirm Inc. and small business banking platform Mercury Technologies. Evolve also provides personal and business banking and mortgage. Evolve is working on fulfilling the requirements raised in the order. One focus of the remaining work is to add more personnel in the compliance and third-party risk management fields and form required committees for oversight. After the order was issued, an Evolve spokesperson issued a statement saying it is well capitalized. However, the Fed's scrutiny of the bank's capital, liquidity, credit, and cash flows suggest concerns about what Evolve's ultimate profile may look like after its ongoing issues are resolved. So again, I think what's a little troubling here is that it says, Evolve plans to continue growing its BaaS business, which is its largest revenue stream. However, so again, and we get back to this issue, what I just talked about, so the bank appears to be well capitalized, as I think most banks around the country are, if not, you never can say all, you can never generalize in that sense, but I would say most. But I think it's troublesome. I think Evolve, and I think you may be able to say this about some other banks around the country, and that is, they love technology. They're all about just adding these technology solutions, growing these things like these BaaS platforms. But you don't want to use the word like reckless, but are they good? I think the question becomes: are they going too fast? Are they moving too quickly with some of this to the point where they don't have the proper back office personnel, that they don't have the proper people doing compliance and review and looking at a lot of these things, third party risk management, and again. And that's what it said. That's what they said right here. One focus of the remaining work is to add more personnel in compliance and third-party risk management fields and form required committees for oversight. There you have it. They obviously did not have enough people working in the background to monitor and manage a lot of these technologies and things that they have been rolling out. And again, I think these are all, fair questions to ask. Like, in other words, if you want this to be your business model, that's fine. But should you, then have to beef up certain areas of your bank to then go along with this? So, okay. And then let's wrap up here. Then it talks about capital constraints here, where it basically says, along with emphasizing operational risk, the cease and desist order imposes capital conservation requirements. Evolve Bank and Trust and its bank holding company, Evolve Bancorp, will need written approvals before they pay dividends, buy back shares, or pay interest on subordinated debt, as well as before increasing debt levels. While capital conservation is not uncommon in Fed cease and desist orders, Haskell noted that the restrictions on the debt payments underscored the regulators' concern. Another fintech-friendly banking institution that faced similar restrictions is Mode 11 Bancorp, which agreed to exit BaaS before the issuance of a cease and desist order by the Fed. You normally would not force a company to ask for approval to make payments on its sub-debt if you didn't have serious concerns about their capital, Haskell said. While capital conservation is a typical lever regulators use in enforcement actions, it does not apply to all fintech-friendly banks that have received such orders. Among its recent actions, the Fed did not impose capital conservation requirements on Metropolitan Commercial Bank. The FDIC also did not impose such terms in the consent orders to Choice Financial Group and Sutton Bank. Given Evolve's struggles, it is more important for its bank holding company to be a source of financial strength for the bank unit, said Chip McDonald, managing director at the McDonald Partners LLC. So as of December 31st, 2023, Evolve Bancorp had total assets of $158 million and total equity capital of $106 million, according to its regulatory filing from the company. The financials imply that the bank holding company's total liabilities are equal to roughly 1/3 of its total assets. This is relatively high, although compliant with regulations because the company is small. Uh, so the, you know, so, and then I'll wrap up with, so it says here, like, having a large capital ratio is not a guarantee of a bank being safe and sound, said an industry lawyer. The other thing is, how do you apply risk management oversight to your capital? So again, very good questions here. I'm going to continue to follow this and report back to everybody as this continues to unfold. But a lot of really fascinating questions here. I think the BaaS model is a good model, and I think there is a lot of promise there with that model. But I think what may, if I speculate here, what may ultimately happen with this is you may get an evolution where if you want to run that BaaS model, that there's just certain things that you're going to have to do as as part of compliance, as part of capital management, as part of managing your liquidity, cash flow, other things like that. Maybe business continuity planning, disaster recovery plans, that kind of thing. Breaking up with partners, fintech partners. These might be things that you might have to be much more diligent about as you enter into more of a niche business line like this. So again, it's going to be very interesting to see that. What I have the biggest issue with is the idea of the capital requirements in this regard, because like I said, there's not enough information there. I mean, how do you put a number? The question becomes, how do you put a number on that? And maybe someday somebody can kind of figure that out and get into that. But like I said, we'll see. But I'm going to, like I said, I'm going to continue to keep an eye on this, because this is going to be this is big. This is bigger than Evolve Bank and Trust. It's bigger than Synapse. This is going to involve the whole banking industry in terms of how you monitor vendor management, your relationships with these fintechs that provide all these different services. So we'll definitely have to keep an eye on this and see how a lot of this unfolds, and ultimately what the regulators propose as we move forward. So anyway, so with that, so if you like this episode, please make sure to like, share, and subscribe, as that always helps the channel. Remember, we are on YouTube, Rumble, and all major podcast platforms. Please make sure to leave your comments down below. Check out some of the episodes that I've posted up recently, and I will see everybody again.